Dave's been trading for 2 years, which in Wall Street years is the equivalent of being a toddler who just discovered fire. His portfolio is up 13% year to date. He just hit it big on a crypto meme coin, and his confidence is at an all-time high. Dave's hobbies include watching The Wolf of Wall Street, telling girls at the bar about emerging biotech companies, and zinning. It's safe to say Dave has what it takes to become a full-time trader. So Dave does what any rational person would do. He calls his broker, lies about his net worth, and gets approved for options trading. Fast forward 3 months, and Dave is now leveraged to the max on out-of-the-money Tesla calls. His strategy? Buy high, sell higher. His risk management? Prayer? His wife's concern. Why is $13,000 missing from our savings account? Fast forward 3 more months, and the Federal Reserve decides to hike rates. Dave's portfolio is now down 67%, and his wife's new favorite hobby is Googling how to divorce a man who calls himself a market wizard. This brings us to the question for the video today. Why do the dumbest investors win? The Dunning-Kruger effect is the financial markets version of Darwinism. It explains why dumb people think they're Warren Buffett, why smart people think they're dumb, and why Dave believes market manipulation is why his calls expired worthless. Since 2020, you could have invested in pretty much any stock and you would have made money. And if you were on the left side of the Dunning-Kruger curve, where Dave was, you would have significantly outperformed the S&P. Traditional value investors think investing is about fundamentals or fair valuations. But the investors who have outperformed over recent years buy companies at 650 times earnings, ride trends that make less sense than pineapple on pizza, and pump their bags to anyone with a pulse. In fact, I believe it was Warren Buffett that once said, "Why buy Apple when you can buy Fartcoin?" And if you zoom out even further, it gets more evident. We've been in the greatest bull market in history, 17 years, 715% returns. The S&P's basically been on a bender since 2009. So over the past 17 years, anything you've invested in would likely have generated a positive return. And because of this, investment strategies characterized by high beta and irrational approaches have outperformed and generated alpha, although it hasn't happened yet. Like all great benders, it must come to an end eventually. But when is this end coming? And how can you prepare for it? Well, there's 2 ways. The first, sit on cash like Buffett has been doing. But that's boring and you're not looking to compound at the risk-free rate. So that brings us to our second option. Continue to go all in and then blame others when the markets inevitably reverse. You can blame Jerome Powell, Donald Trump, or even market makers. But you gotta blame someone because taking losses on the chin isn't how